Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Wheels Up stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Wheels Up is like Uber for private planes, and they offer member and non-member rates. You can book private flights using the app on your phone. They differ from their competitors such as NetJets. On that service, members own shares of specific aircraft. This company has over 10,000 active members. Private jets have been around a long time, but the demand for private flights has grown due to COVID because some people do not want to go to airports and be around big crowds. A big issue with a company like this is there's only a small percentage of the population that can afford their service. To give you some examples, if you are not a member, you can purchase a flight from New Jersey to Miami for $15,300 or Southern California to Vegas for $7,000. If you wanted to be a member, the cheapest membership is $3,000 upfront and $2,500 per year. In addition to those rates, you have to pay for the cost of the flight, which would be less than the non-member rate. You can take private flights or you can share a flight with another member to save money. There is an option on the app to let the other members know what flight you want to share, and another member can join you so you can both save money. After this company acquired Delta Private Jets, Travel Management Company, and Gamma Aviation Signature, it became the second largest private aircraft operator in the US, behind NetJets. It was funded by a SPAC, a special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. At the time of their IPOs, SPACs have no existing business operations or even a company they plan to acquire. SPACs have 2 years to complete an acquisition or they must return the funds back to investors. Aspirational Consumer Lifestyle is a SPAC that acquired this company. They valued Wheels Up at $2 billion in July, and Wheels Up received $650 million of cash from the merger. The company is headquartered in New York, and was founded in 2013. It started trading this year and can be found on the New York Stock Exchange. Let's get started with the model. This is a small cap company, 1.6 billion market cap. They're trading at $6.70 a share, and they have 246 million shares outstanding. Let's look at the financials. There's not much info on this company. There's no 10Ks or 10Qs since they just went public. The only information I found was in their presentations and also some info on Google Finance. In the second quarter of this year, they had $286 million of revenue. $213 million was from flight costs. $16 million was from their membership costs. $50 million was from aircraft management. I'm not really sure what this is. And $7 million from other. The company mentioned in their presentation it expects to have 1.05 to 1.1 billion of revenue in 2021. That looks like it makes sense because if you multiply this number by 4, it's pretty close to that number. So I used a lower number, 1.05 billion, as their projected revenue. According to Simply Wall Street, the average analyst projects their revenue to grow 14.4%. I thought that was a little aggressive, so I cut that in half, 7.2%, and I grew their revenue 7.2% each year until 2028. This chart is from Google Finance, and it says their 2018 revenue was about $360 million, and they had a loss that year. 2019, it was about $390 million, a bigger loss that year. And 2020, they had about $650 million of revenue, and they also had a loss that year. The revenue does look pretty good. They are growing a lot. To figure out the free cash flow for 2021, they reported their second quarter EBITDA, which was negative 8.5 million. EBITDA is really close to operating cash flow. And they also reported 5.6 million of CapEx. So negative 8.5 million minus 5.6 million is about negative 14 million. So in the second quarter, their free cash flow was negative 14 million. And if you multiply that by 4, that's negative 56 million in the whole year. I think it'll take a while for them to get positive free cash flow, so I gave them negative for the next 4 years. And the average company converts 10% of their revenue to free cash flow. So I converted 5% of their revenue in 26 and 27 to free cash flow, and 10% in 2028. And I estimated their WACC at 9.36% by looking at their numbers and also their competitors. And that's the discount rate we're going to apply to the future cash flows. We estimated 8 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 8 at $3.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.4 billion. We divide that by 246 million shares. And we get a calculated stock price of $9.71. They're trading at $6.70, so they're trading at a 31% discount. It's a buy according to the model. But as you know, a lot of these SPACs are really risky, so anything can happen. I'm assuming the company will continue growing at a 7% rate, which of course might not happen. They may not grow at all. Simply Wall Street values the company at $28, so they're saying it's 76% undervalued. 6 analysts priced this stock and the average price target was $13.40. This is where the stock has been trading the past year. So when a stock is just a SPAC, it hasn't acquired a company, it usually trades around $10. So you can see it was pretty flat. But once they acquired this company, then it went downhill. It's really odd. As soon as they acquired this company, the stock went down dramatically. The only thing I could think of is a lot of the people who owned this stock before it merged, a lot of the insiders, sold off as soon as it merged and took in their profits. The stock is down 31% while the S&P is up 29%. The low is 643, the high is 15, and the stock of course is trading below its moving averages. Anywhere from 1 to 2 million shares are traded each day on this stock. Of the 245 million shares outstanding, only 50 million are on float, so it has a low float percentage. 30% are held by institutions and 1.39% of the shares are shorted. Analysts are projecting their earnings to grow 50% and their revenue to grow 14%. The industry projection is for the earnings to grow 64%. That's really high. If you put $10,000 into this company when it started trading as a SPAC, you'd be down at $6,800 today. That's a 32% loss. When this company acquired Delta Private Jets, it looks like it gave Delta 21% of its stock. Because obviously it didn't have much cash to acquire a company, so they just gave stock in their company. Fidelity owns 7.4%. The CEO of the company owns 5.7%, then T. Rowe Price and Franklin Resources. To summarize, I have them trading at a 31% discount, and I can't really calculate most of their ratios because I don't have the info, but I kind of backed into the price to sales ratio. It's 1.3, which is pretty good. They are generating a lot of sales, so that is impressive. I'm just not a huge fan of this business model because not many people can afford their services. A lot more people will buy a $50,000 car than use their services. If I was going to Vegas from California, I don't think I'd want to spend $5,000. I'd rather spend $300-400. I could afford $5,000, but it's just not worth it to me. Maybe if I had $100 million, maybe it wouldn't be a big deal. And it's not really a scalable business model. Like Tesla is scalable. They could pump out lots of cars. Kellogg's is a scalable company because they can make so many products and ship them all around the world. With this company, every time there's a flight, you need a plane and you need a pilot. It's hard to mass produce these flights. I know the flights are expensive, but they are losing money. So maybe they will start making money in the future. Even with nearly $300 million of revenue in one quarter, they're not profitable. I don't know why, because I can't see their financials. The next quarter, I will be able to see their financials, and I can do a more thorough review of the company. But just because I don't like a company and I won't invest in it, doesn't mean it won't go up. I don't have to like every company. There's so many options out there. I could just find a company I like. There's been plenty of companies I regret not buying, like Tesla. Maybe in hindsight, I should have invested, but at the time, I just couldn't do it. Do you think this will be another failed SPAC? I don't know. Only time will tell. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.